My name is Gane Hovakimian. Today I'd like to talk about an article that I published in March in the Journal of Financial and Quantitative Analysis titled Corporate Leverage and the Dynamics of its Components. The issue of capital structure is one of the cornerstone issues in finance and particularly corporate finance, and it's related to many important aspects of corporate behavior. For example, cost of capital, investment decision, and others. When we talk about capital structure, which is the proportions of debt and equity that firms choose to use to finance their operations, there is, of course, the actual capital structure that we observe. There is a rigorous theory which suggests that firms may be targeting some optimal leverage ratios. The dynamics of capital structure is a very interesting issue, and there are works related to that, but they report findings that may seem contradictory. I approach the question using a new methodology. I take the observed capital structure levels and decompose it, looking at the dynamics of all three components: the observed capital structure levels, the levels of the targets that I have estimated, and the levels of the deviations. I have used decades of data starting in the 60s up to the 2015 and beyond. I'm using a huge data set, and this enables me to do an in-depth empirical analysis. This method has also allowed me to look at variations in deviations from the target by deviation characteristics, firm characteristics, and time characteristics. I'm able to see, based on my results, what is driving the observed cross-sectional stability in capital structure and what is driving the time series variability. And what I find is that the cross-sectional stability is driven mostly by persistent targets, and time series variation is driven mostly by transitory deviations. This has not been possible to see with previous approaches to the issue. One interesting result that I find is that the persistence of deviations is more driven by how costly it is to be deviated from your target. Deviations that are positive and larger deviations are less persistent than smaller deviations and negative deviations. What this tells us is that firms are more wary of being over-levered than under-levered. The persistence of deviation for an average firm is virtually zero at a 3-year horizon, and this is one of the strongest supports for the dynamic trade-off theory in literature. These findings clearly extend the existing knowledge on capital structure and its dynamics, and they're helping to reconcile the seemingly contradictory findings that we see in literature, in particular the cross-sectional stability in capital structure ratios and its time series variation.